Welcome to TalkTickers. You're here because you want the crucial insights from the latest earnings calls without wading through hours of corporate jargon.
Exactly.
Today, we're diving straight into Prudential's most recent earnings call, our mission, to really extract what matters and give you a clear picture of their performance and, where they might be heading.
Let's do it.
So let's get right to it. What were the headline numbers?
Okay, so for Q1 2025, Prudential reported pre-tax adjusted operating income of $1.5 billion.
$1.5 billion.
Which works out to $3.29 per share. Now, that's actually up 8% compared to the same time last year.
Okay, 8% up. What was behind that?
Well, the main driver was their U.S. businesses. They had favorable underwriting results, and think of that as, how well they manage risk on their policies and also lower expenses overall.
Lower costs helping out.
Definitely. But look, it wasn't all smooth sailing. Their income from alternative investment stuff like private equity, real estate, that actually fell short.
Oh, by how much?
About $90 million short of what they expected, just weaker returns there.
So yeah, even though earnings were higher year over year, management themselves kind of said, look, recent results didn't quite hit our own benchmarks.
So managing expectations there, what about looking forward?
They did reaffirm their intermediate term goal. That's the 5 to 8% average core adjusted operating EPS growth running through 2027.
Right.
But they also acknowledged, there are some near-term headwinds, things slowing them down a bit in the short run.
Okay, so a bit of a mixed bag then. Strong in some core areas, weaker on the investment side, and sort of a cautious immediate outlook. Let's dig deeper. Starting with the new CEO, what was his perspective? Priorities, concerns?
Right. The new CEO, his message really centered on needing a sharper focus on growth and creating value.
Growth and value. Where did he see the opportunities?
He pointed to, significant opportunities globally in protection and retirement needs, big markets there. Plus, investor appetite for private credit and alternatives. That's still strong.
Okay.
And interestingly, he also really highlighted the progress they've made in de-risking the company. De-risking. How so?
They've cut their exposure by nearly 60% to some of the more, let's say, volatile products. Things like traditional variable annuities and guaranteed universal life insurance.
Wow, 60%. That sounds like a pretty major strategic shift. Could mean more stability down the road.
Exactly. That seems to be the idea. The CEO emphasized a commitment to a, quote, higher performance standard. And his strategy seems to boil down to three things: evolving their strategy continuously, executing consistently, actually doing what they say they'll do, and fostering the right kind of culture.
Makes sense. But you mentioned headwinds earlier. Did he elaborate on those?
He did. So in the U.S., they expect earnings pressure to continue from those older volatile blocks of business running off. That's sort of a known factor.
Right, the runoff.
And then in Japan, they're facing issues with elevated surrenders of U.S. dollar-denominated products. Basically, customers cashing out early, partly because the yen is weaker.
The currency impact. How significant is that?
They estimate it could be a 3 to 4 percentage point drag on EPS growth in 2025.
Oof.
Yeah, but they do expect that effect to dissipate over time. It's not seen as permanent.
Okay.
And finally, he mentioned they're always evaluating how best to use their capital, investing organically, M&A, maybe selling off parts of the business. All options are sort of on the table.
Okay, let's switch over to the CFO side, the financial details. What else stood out beyond the main income numbers?
Well, the CFO talked about PM, their asset management arm. AUM assets under management grew 3% year over year, reached $1.44 trillion.
$1.4 trillion. That's a huge number. What drove the growth?
A mix of things. Market appreciation, so investments going up in value. Net flows of $4.3 billion.
So more money coming in than going out.
Exactly. And a strong investment performance overall. If you drill down into those flows, institutional clients were strong, $4.6 billion in net inflows there. Retail was a bit weaker, modest outflow.
Okay. And alternatives, you said income was down, but any other detail?
Yeah, their private alternatives platform was actually pretty active in deploying capital. Over $10 billion put to work, which is up over 60% year over year.
A big jump.
Huge jump. But that activity did slow down a bit late in the quarter.
Got it. What about the U.S. business results, digging in a bit more?
So, like we said, good underwriting, lower expenses. That was the positive. But offsetting that somewhat was lower fee income from those legacy variable annuities, the runoff effect again, and lower spread income.
Spread income being the profit margin on investments.
Basically, yeah. And that was down partly because of those weaker alternative investment returns we talked about.
And international.
Similar story on spread income. Their lower alternative returns hit them too, plus some unfavorable foreign exchange movements.
Right. The currency factor again. Any bright spots?
Oh, yeah. Retirement Strategies had a really strong quarter, over $10 billion in sales.
$10 billion. Wow. What was in that?
Included a couple of large international longevity reinsurance deals, basically taking on pension risk totaling $5 billion.
Right.
And record sales and structured settlements. Individual retirement sales were also up 5%, driven by registered index-linked annuities, RLAs, and fixed annuities. People looking for some guarantees, maybe.
Seems likely. How about international sales overall?
Up 15%. Strong growth in Japan, surprisingly given the surrender issue, but retirement and savings products were up over 20% there. And record sales in Brazil, too, in emerging markets.
So quite a lot happening on the sales front and the overall financial position.
CFO emphasized it's strong. They're sitting on $4.9 billion in cash and liquid assets, so plenty of flexibility.
Good buffer. Okay, let's move to the Q&A. Analysts always try to get behind the numbers. What were some key insights there?
Yeah, several interesting points came up. Capital deployment was one.
Yeah.
Management basically said, look, we're always reviewing our plans, organic investment, M&A, divestitures based on the market.
So flexible.
Right. They like their current plans, but expect them to evolve. On PM margins, Q1 was disappointing. They acknowledge that. Often is the lowest quarter due to compensation timing.
Seasonality.
Exactly. But they're still confident about hitting that 25-30% adjusted margin target over the medium term. They think investment growth, market recovery, cost control will get them there.
And the runoff of those volatile blocks. Any more big moves planned?
They said, basically, don't expect another huge, dramatic shrink right away. They've done a lot already. But optimizing it is still a priority.
Okay. What about Japan? You mentioned the surrenders, but also new regulations coming. ESR.
Right, ESR. It's a new capital framework. They expect their capital levels to stay strong, above AA equivalent, even after it comes in next year, and they don't see it impacting their ability to pay dividends.
They're planning for it then.
Yeah, they stress that. Adjusted products, used reinsurance. Actually, about 70% of their US dollar liabilities in Japan were reinsured outside Japan by the end of 2024.
That's a significant hedge.
Definitely. Then there was more on variable investment income, or S7. Q1 was lower, as we said, due to private equity and real estate. The near-term outlook there is, well, challenging. Market uncertainty.
Did they quantify that risk at all?
They gave a hypothetical. If the equity market dropped 10% and then recovered slowly, like 1.25% a quarter, they think it could knock 2 to 2.5 percentage points off their medium-term alternative return expectations over a year.
Okay, helpful sensitivity. What about the life insurance business they are keeping, not the runoff stuff?
Right, the go-forward individual life business. Management sees real strategic value there. It's less interest rate sensitive, capital efficient, profitable, complements their other mortality longevity risks. Strong brand, good underwriting. They made a clear distinction from the old GOL business.
Got it. Back to Japan surrenders. Any sign of that slowing down?
They said the pace is showing signs of stabilizing, which is, potentially good news. They estimate the hit to 2025 earnings from surrenders that happened in 2024 will be around $100 million. Most contracts are past the penalty phase, so that might help stem the tide a bit.
Yeah, what are they doing proactively?
Diversifying products. 20% of recent sales are from things launched in the last 2 years. They've doubled their yen-based offerings and just providing more customer support.
Makes sense. Anything else jump out from the Q&A?
Institutional retirement earnings were down slightly despite those strong sales. That was due to some internal expense allocation changes, lower income on cash balances because short-term rates fell, and a small change in derivative accounting. So kind of technical stuff masking the good PRT sales benefit.
So the pension risk transfer market is still healthy, despite maybe some litigation noise out there?
Yeah, they said market size is as expected, no impact from litigation currently. They do think 2025 might see some normalization, maybe slow down a bit due to volatility, but the long-term picture is still very strong. Huge untapped market, pension plans are well-funded, it's just a transaction business, so it can be lumpy.
Right. Inorganic growth M&A.
Still a tool, but organic growth is the top priority. They have a high bar for deals looking for higher growth, capital-efficient targets.
Okay. What about interval funds? Seen some buzz around those.
Yeah, they mentioned Prudential PIM has been introducing them, see it as a growth area, plays to their strengths in both public and private markets.
And the EPS guidance clarification, the 5-8% average.
Key point there. It's an average over 3 years, not linear. Those near-term headwinds like Japan surrenders and the VA runoff, they're already baked into that 5-8% target.
Gotcha. So bumps are expected.
Right. And they put a number on the VA runoff impact for 2025, roughly $150 million cumulative hit. The baseline EPS for that 5-8% growth, by the way, is $13.67 for 2024, adjusted for seasonality.
Oh, useful baseline. Capital return. Buybacks, dividends.
The 65% free cash flow target is an over-time measure, not quarterly. Priorities are unchanged. Balance sheet strength first, then investing in the business, then shareholder distributions, dividends, and buybacks. No changes anticipated there.
What about hedging the yen?
They don't hedge their earnings from Japan back into dollars, but they do hedge their equity exposure in Japan as part of capital management. That hedging is factored into their ESR calculation.
Okay, subtle distinction. Life insurance core earnings were up slightly.
Yeah, they said that reflects the new business profitability offsetting the runoff drag. They see that as sustainable, not a one-off.
Interesting. Any other sensitivities mentioned besides equities?
Just interest rates. A 50 basis point drop, a one-time shock, could lower annual EPS by about 20%. So still quite sensitive there.
Wow, 20%.
Okay.
And the dividend itself? Secure.
Remains a key part of allocation, balanced with everything else. No anticipated changes.
One last area, group insurance. How's that doing?
Strong premium growth there. Group life and disability doing well, reflecting their strategy and pricing discipline. They're investing in customer experience, claims management, and seeing good sales growth, particularly in the smaller employer market under 5,000 lives.
Okay, that covers a huge amount of ground. That was a very detailed call.
It certainly was. Lots to unpack.
All right, now for the part where we put on our thinking caps, our This Is Not Financial Advice segment. Looking at everything we just discussed, what's an outrageous but plausible trade idea that springs to mind?
Okay, all right. So management keeps talking about the long-term strength of private credit and alternatives, right? Even though things are a bit choppy now, deployment slowing down.
Confidence in the long run.
Exactly. So here's a thought. What about considering maybe a long position in a newer investment trust or maybe a closed-end fund that's specifically focused on direct lending, particularly one targeting loans made in, say, 2026 or 2027, the next couple of vintage years?
Okay, why those years specifically?
Well, the thinking is the current caution and maybe slower deployment now could mean less competition and potentially better terms, higher yields, better protections for lenders putting capital to work in the next few years, especially if the economy finds its footing.
So playing on the idea that current headwinds create future opportunities for those deploying capital later.
Precisely. And the fact that Prudential, a major player, is so heavily involved and confident in this space kind of suggests it's a broader theme, not just company specific. Maybe attractive entry points are forming for medium-term private credit.
Interesting angle. Capitalizing on potential future lending conditions.
Yeah. But very importantly, remember everyone, this is absolutely not financial advice. It's just an idea based on the discussion. Always do your own deep research and please consult with your financial advisor before making any investment decisions.
Excellent reminder. A fascinating, if definitely unconventional idea to mull over. Okay, that wraps up our deep dive into Prudential's latest earnings call. We've hit the key results, the strategic thinking, some of those Q&A nuances.
Hopefully give you a much clearer picture than just the press release.
Absolutely. We hope this provides a solid starting point for your own thinking and research. Thanks for tuning into TalkTickers.